This is for the loan associate for Integrity Capital. This is training for what we call the deal model. So what this is specifically is once you've gone through all of your vetting process for a transaction, you get to this place where you're trying to figure out, okay, how do I structure this deal, and then what lender type or loan type am I going to go through? So we've designed a funneling process called the deal model, which will help you walk through the transaction and find out what the central piece is that you need to focus on, and then be able to respond to the client in real time as to the specifics and realities of their circumstance. So the very first thing you'll do when you come into the deal model that you'll have access to is you'll identify if it's, again, owner occupied, where a business is going to actually move into the building, or if it's investment, or it could be both. And so that'll help you focus a little bit. I'm just going to give you one example here. There'll be a bunch of them as this gets built out, but what you're trying to focus on is what is the focal point for them. And there's going to be a lot of different scenarios where it could be just the non-cash flowing property. Okay, so that's the fundamental issue, or the deal focal point. Could be that they want non-recourse, and that's the main focal point for them. It could be that there's some credit issues. Okay, that could be the focal point. So we're just trying to give you, like, what is that main focal point that they're running into? Hey, I want the best interest rate. Okay, so that's the focal point. Hey, I want no prepayment penalty. So I guess you're sort of getting the gist. We want to find out what is that major thing that's so important in the focal point of the deal. In this case, call it non-cash flowing property. Then you go down and say, okay, what's the loan type? Investment, purchase, or refi. Okay, great. Loan is 1 million plus. Great. And then you start to be able to tell them, hey, it's got to be at least 60 to 65%. Can't go higher than that. Or lower, essentially, because you have a non-cash flowing property. Credit must be good, and if there are issues, it better be explainable. Okay, that's kind of your response to that situation. So if you have any deviations from what the standards are, then that's going to be a stopping point for you to say, hey, we've really got to address this. So you'll either stop it with them, or you're going to have to address it with your manager. Client's net worth, has to be at least 1.5 times the loan amount, and they should probably have at least 12 months of payments post-closing. Okay, so that's after the loan closes and they put their money in there. Then we need to still see that there's that much liquidity. Okay, cash flow. Should have good projections month by month. So if it's a vacant property, it's not cash flowing. Do they have projections they put together? What's going to be their outside source of repayment for this as well? That'll be another element that you'll talk about with them. Client resource desire. So if non-recourse, so if they're saying, hey, it's not cash flowing and they have to have non-recourse, it's really going to have to be a bridge lender. And if it's recourse, they can go to a bank. The client pricing, if they want low rates, they'd better have a ton down and along with a lot of liquidity. And it says see bridge loans. Again, it's pointing you to places to go. Client prepayment desire will be yield maintenance or a step down. If they want none, then it will have to be banks. So it's saying right down here, based on all these things, if it falls within this criterion, you're going to go down here and look at bridge loans or banks. So you'll go over here to, call it, bridge loan, and then you're going to walk through the particular section. So let's just say, for example, over here, that it ends up being a SBA mediocre loan. You're going to be able to tell them, here's the pricing and what it's going to look like, interest rate, the loan to value, 85 to 90%, the amortization, the term, fixed periods, prepayment penalty, the fees that are involved, what reports are needed, how long it's going to take to close, our fee origination, and just other facts. They're going to take a second on the real estate. They're going to need a life insurance policy that won't work if they've ever defaulted on SB debt. So this really is the starting place to help you structure the loan, and it'll help you know where to go down here. There'll be an updated key to basically identify and know, what type of transaction or type of lender are you going to focus on. So the goal of this section is to really give you a lot of confidence and data to quickly get up to speed onto what is acceptable in order to align with reality of the expectations of the borrower. Because they might have something in their own mind, like they might say, hey, I want 75%, and the reality is the market doesn't bear that, and et cetera, et cetera. So this isn't perfect. It's not going to hit everything, but it's very good to give you the tools you need in order to have success in structuring a deal, as well as being able to give some feedback on the types of terms. And we want to do it more real time to be proactive so that we can be distinct and unique and find out if they're really serious or not to do a loan with us.